Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. Inflation on consumer goods in China eased to an annual rate of 2.5% in December, giving bulls something to cheer about. China's central bank may now have some added flexibility with its approach to the economy. The People's Bank of China has been raising money market rates and bond yields to cut down on the growth of credit and levels of debt. And while the PBOC will likely continue their current policies, the market breathed a sigh of relief that further tightening could be avoided. Despite having more options at their disposal, the central bank says it will maintain what it calls prudent monetary policy and keep enough money in the system to avoid shocks from adjustment. This gradual approach to structural reform is a high priority for Beijing, which is keeping a close eye on corporate and local government debt. Credit had sharply expanded in the past few years, first to deal with the financial crisis and then to maintain growth. While price growth was muted, analysts warn inflation may pick up in the months ahead as the government reduces subsidies and pushes market-oriented reforms to liberalize energy and utility prices. Reuters quoted economist at ANZ in Shanghai, Zhou Hao, who says with Chinese New Year coming, inflation for January will likely be over 3%. Zhou says as pricing reforms take effect, CPI could exceed 3.5% in the second half of this year. China's National Bureau of Statistics said for 2013, inflation was 2.6%, well within the government's target limit of 3.5%. The Bureau also said that prices at the producer level fell 1.4% last month from a year earlier. This is the 22nd consecutive month of decline. Excess manufacturing capacity, along with weak global commodity prices, have weighed on producer prices. Deleveraging will be one of the buzzwords to watch in 2014 as authorities try to deal with the country's massive shadow banking sector. Reuters reports that China's cabinet, the State Council, has issued new policies to strengthen regulation of off-balance sheet lending in an effort to contain the growing risk of a debt crisis. China economist at Nomura in Hong Kong, Zhang Juwei, said in a research note that the crackdown on shadow banking will likely intensify and financial institutions may need to deleverage further. In the Financial Times, Simon Rabinovich says the government's campaign to rein in lavish spending by officials made an unexpectedly big impact on the wider economy. Rabinovich writes that some had expected this belt-tightening would wane after a while, but instead it has intensified, resulting in lower food prices. In typical years, food costs go up as offices around the country throw banquets in the run-up to Chinese New Year, which begins at the end of January. Rabinovich says in his first year in office, President Xi Jinping has ushered in a new style of austerity, ordering officials to cut back on waste. Dean of the School of Finance at the Beijing-based Capital University of Economics and Business, Xie Taifeng, says the impact of austerity on consumer prices could be bigger than many people realize. Xie says apart from reduced spending on conferences, a ban on luxury gift-giving and vouchers will have a major effect as well. The central bank's steady tightening of monetary conditions is also weighing on inflation. Over the past 6 months, the central bank has steered money rates to higher ground, pushing banks to cut back on their lending and indebted companies to reduce their leverage. If authorities, though, can manage to balance the reduction in credit with enough growth in employment, then China will be well on its way to getting through this middle-income period and onto a sustainable long-term path. You're watching Biz Wire on the Blue Ocean Network, China's first and only privately owned English-language broadcast media. Our full episode can be seen on our website, BONTV/biz-wire. In just a moment, we'll continue with more insight into the big picture of China's economy.